It is late 2025, and U.S. home prices are near all-time highs, $415,200 for a typical house. Even as sales crawl at recession levels, and over half of homeowners are trapped by ultra-low mortgages they cannot afford to give up. Why is the market so frozen, and who benefits from squeezing buyers to the breaking point while affordability hits 40-year lows? This is not a rerun of 2008, but the danger of a housing bubble with new rules has never looked more real, and what no one is telling you about how we got here changes everything. The numbers tell the story. In September 2025, the median price for an existing home in the United States stood at $415,200. That is not just a new high. It is the 27th consecutive month that prices have risen year over year. Yet beneath the headline, the market's pulse is faint. Existing home sales are running at an annualized pace of just 3.87 million. Not since the mid-1990s have transaction volumes dropped this low outside of a recession. For every home that sells, there are far fewer buyers than in any typical year over the past decade. Inventory is up, but only in relative terms. There were 1.55 million homes listed for sale in September, an increase of 11.5% from the previous year. But even with that bump, the market is still tight. The national supply sits at 4.6 months. Historically, a balanced market hovers closer to 6 months. Today's levels barely give buyers breathing room, and for sellers, it is a standoff. Many would-be movers are holding back, unwilling to trade their current deals for an uncertain future. Price growth is beginning to lose steam in the major indexes. The Case-Shiller Index reported a year-over-year increase of 3.4% in March 2025, while the Federal Housing Finance Agency measure showed a 2.9% gain in the second quarter of 2025, with prices essentially flat quarter over quarter. The relentless climb is slowing, but the plateau remains high above what most households can afford. This disconnect between soaring prices and sluggish sales is not just a statistical quirk. It is a sign of a market where demand is being squeezed, not by a flood of supply or a collapse in confidence, but by the simple math of affordability. The National Association of Home Builders reports that by mid-2025, a median income family needed to spend about 36% of their earnings to buy a median-price new home. That is well above the 30% threshold the Department of Housing and Urban Development defines as the upper limit for affordability. For many, the cost of ownership has simply become unreachable. The market's thin volume has other consequences. With so few homes changing hands, price discovery is murky. Sellers who can wait are holding out for last year's prices, while buyers face a shrinking set of options and little leverage to negotiate. The result is an uneasy stalemate. In some regions, especially in the Sun Belt and Mountain West, investor activity remains strong, and all-cash offers still make up nearly one-third of purchases. That keeps prices sticky, even as the number of willing and able buyers dwindles. Despite the pressure, forced selling remains rare. Only about 2% of mortgages are underwater, a fraction of the levels seen during the last housing crisis. Most homeowners have substantial equity, and delinquencies, while ticking up, are still below long-run averages. But the cracks at the edges, rising foreclosures and more listings in distress, are starting to show. Behind every number is a household making tough choices. For some, the dream of homeownership is drifting out of reach. For others, the ability to move is locked behind a wall of higher costs and uncertain prospects. The market is not frozen in the way of 2008, but it is stuck, caught between high prices, low sales, and the hard reality of what buyers can actually afford. Maya sits at her kitchen table, running the numbers. She bought her home in Phoenix during the summer of 2021. Her mortgage rate is 2.75%, fixed for 30 years, an offer that seemed almost too good to be true at the time. Now, just 4 years later, the world outside her front door has changed. The going rate for a new mortgage is more than double what she pays, closer to 6.2%. For Maya, and millions like her, that difference is not just a statistic, it is a wall. Over half of all mortgaged homeowners in America now have rates below 4%. For roughly 1 in 5, the rate on their loan is at or above 6%, the highest share in over a decade. The gap between what most owners pay and what it would cost to buy their own house today is wide enough to trap them in place. For Maya, selling would mean giving up a $1,400 monthly payment for something that could easily top $2,400, even if she bought a similar home. The math does not add up, and she is not alone. Redfin's research shows that for every percentage point increase between a homeowner's current mortgage rate and the market rate, the odds they will list their home drop by nearly 1/5. It is a pattern that repeats across the country, but it is most pronounced in places where the pandemic buying frenzy was hottest, cities like Austin, Miami, and Denver. There, the share of locked-in owners is even higher, and the supply of homes for sale is even thinner than the national average. The result is a kind of invisible freeze. Owners who might have moved for a new job, a growing family, or just a change of scenery find themselves boxed in by the penalty of higher rates. The median tenure for homeowners with loans below 4% is now stretching past 10 years, far longer than historical norms. Many listings that do appear are withdrawn or expire unsold, as sellers balk at the offers they receive or realize they cannot afford the next step up. Maya's story echoes through her neighborhood. Her neighbors, the Kims, refinanced in 2020 and have no interest in moving, even as their family outgrows the space. Down the street, a retired couple considered downsizing, but the cost of a smaller home with a new mortgage would actually increase their monthly expenses. In each case, the financial penalty for moving is enough to override almost any other reason to sell. This rate lock effect is not just about numbers on a spreadsheet. It is reshaping the everyday lives of families who might otherwise move for opportunity or necessity. Divorce, death, and job transfers still force some to list their homes, but the majority will stay put, no matter how restless they feel. In some metros, the gap between expected and actual transactions is now more than 20%, a missing wave of listings that never hit the market. The consequences ripple out. With so few homes available, prices remain elevated even as buyer demand softens. The market's thin supply keeps competition high for the rare, attractively priced listing, while most would-be sellers watch from the sidelines. Builders, sensing the standoff, have begun to offer their own incentives to lure buyers, a trend that is starting to reshape the market for new homes. For Maya, the decision is simple: stay put, keep the low payment, and wait. For the housing market, the freeze continues, held fast by the invisible grip of the rate lock. Alejandro Gonzalez steps into the sales office of a new subdivision in San Antonio, greeted by banners promising monthly payments that seem almost too good to be true. He's heard the stories: friends locked out of the market, neighbors unable to move. But here the builder's pitch is different. For Alejandro, it's not just the granite countertops or the backyard upgrades. It's the promise of a mortgage rate below 4%, a number that feels like a relic from another era. This is the new playbook for America's home builders. With the resale market gridlocked by rate lock inertia and affordability stretched, builders are reaching deep into their toolbox. The most powerful lever is the rate buy-down, a temporary reduction in the buyer's mortgage rate funded by the builder that slashes the monthly payment for the first few years. In 2025, more than 60% of new home sales include some form of rate buy-down or concession, according to the National Association of Home Builders. The typical incentive package now runs between $20,000 and $35,000 per home, 6 to 8% of the sale price, often hidden from the final reported price. For Alejandro, the numbers are enticing. On a home priced at $500,000, a 3-to-1 buy-down means his first year's payment is calculated at just 4%. That's $1,910 a month, compared to $2,661 at the full 7% rate. The payment inches up each year, 5% in year 2, 6% in year 3, before settling at the full rate in year 4. The builder's lender assures him he'll qualify based on the highest payment, But the sales pitch is all about the savings today. Closing cost credits and upgrade packages sweeten the deal, further reducing the upfront cash needed to buy. Builders prefer this strategy to outright price cuts. By keeping the official sale price high and burying the incentives in the fine print, they protect neighborhood comparables and avoid triggering appraiser markdowns. It's a way to move inventory without signaling distress. But for buyers like Alejandro, the risk is real. When the buy-down expires, his monthly payment will jump by $750, an annual increase of $9,000. If rates stay high and refinancing is not an option, that payment shock could strain even a careful budget. Industry data shows that in 2025, at least 30% of new home buyers using buy-downs will face payment resets of $6,000 to $8,000 a year. Builders argue that most buyers will refinance before the cliff arrives, but that bet depends on the broader economy. If home values stagnate or rates refuse to budge, a wave of buyers could find themselves squeezed. For now, the incentives keep sales flowing and construction crews busy. 1.32 million new homes started this year alone, though builder sentiment remains cautious, with the NAHB index stuck at 37. Alejandro signs the paperwork, hopeful that his income will grow or that rates will fall before the reset hits. For him, the incentive is a ticket to homeownership he thought was out of reach. For the market, it's a way to delay distress, not erase it. The true test will come when the teaser rates run out and the real cost of today's deals comes due. A new force is reshaping the housing market from the ground up. A surge in rental supply not seen in nearly 4 decades. In 2024, developers delivered 608,000 new apartments across the country, the highest tally since 1986. That momentum carried through 2025, with more than 100,000 units coming online each quarter. This wave of new construction is most visible in fast-growing metros, Dallas, Phoenix, Atlanta, where cranes fill the skyline and leasing banners stretch across glass towers and garden-style complexes alike. The key word here is rental, because supply is changing the market in a fundamental way. For renters, the effect is immediate. Nationally, multifamily rents are rising just 1.7% year over year as of September 2025, according to Zillow, one of the slowest paces in recent memory. In some cities, landlords are offering free months, gift cards, or reduced deposits to fill vacancies. The pressure is strongest in places where new supply is concentrated, but even in tighter markets, the days of double-digit rent hikes have faded. For the first time since 2021, rental affordability has improved, reaching a 4-year high. More families are finding it possible to secure a lease without stretching their budgets to the breaking point. This cooling in rent growth is more than a relief for tenants. It is shifting the calculus for would-be homebuyers. For many, the gap between the cost of buying and renting has grown too wide to ignore. Monthly mortgage payments, already inflated by high rates and record prices, now look even steeper compared to the steady or even falling rents on new leases. Households that might once have felt pressure to buy before being priced out are pausing, weighing the risks of locking in at today's costs against the flexibility and relative affordability of renting. The ripple effects extend beyond individual budgets. As more people opt to rent, the demand for home purchases softens further, reinforcing the gridlock in the resale market. Builders are watching closely. Some are pivoting toward rental projects, betting that demand for apartments will outlast the current freeze in home sales. Others are slowing new starts, wary of overbuilding into a market where tenants have more choices and leverage than they have in years. The slowdown in rent growth is also beginning to filter into the broader economy. Shelter costs make up 1/3 of the Consumer Price Index, and for much of the past 2 years, rising rents were a stubborn driver of inflation. But that dynamic is changing. Zillow now projects that owner's equivalent rent, the metric used by the Bureau of Labor Statistics to estimate housing inflation, will slow to around 3.5% year over year by the end of 2025, with further deceleration expected in 2026. As new leases reset at lower rates, the lagged effect should gradually ease pressure on headline inflation, giving policymakers and households alike some breathing room. The rental supply wave does not solve the affordability crisis for everyone. In high-demand cities, rents remain burdensome for many, and the benefits of new supply are unevenly distributed. But as the market absorbs this unprecedented influx of apartments, the immediate winners are renters who finally have options, and a housing market that, for once, is offering an alternative to the relentless squeeze of ownership costs. Debt in American households has reached $18.63 trillion as of the third quarter of 2025, a number that's quietly reshaping the financial plumbing beneath the housing market. Each month, more borrowers are missing payments. The national mortgage delinquency rate, now 3.97%, has ticked up in 41 states, according to the Mortgage Bankers Association. While still below the historic averages that haunted the last crisis, the direction is clear. Stress is building at the edges, and it's not evenly distributed. Foreclosure filings are climbing from their post-pandemic lows. In the third quarter of 2025, 101,513 properties received a foreclosure filing, a 17% increase from a year earlier. Of those, 72,317 were new starts, up 16%. These are not yet the waves that swept through neighborhoods in 2008, but in certain markets, especially where investor activity and rapid appreciation were most intense, the cracks are starting to widen. In places like Austin and Tampa, the share of listings citing mortgage or debt payments, as the main reason for selling, is quietly rising. The story of credit stress isn't just about missed mortgage payments. Homeowners are tapping their equity at a pace not seen since the last housing boom. In the first quarter of 2025, Americans withdrew roughly $25 billion through home equity lines of credit and second lien loans, a 22% jump from the previous quarter and the highest total in 17 years. For some, this is a way to manage higher living costs or consolidate expensive credit card debt. For others, it's a last-ditch attempt to stay afloat as payments outpace income. Credit card delinquencies have also hit their highest level since 2012, a warning sign that household balance sheets are stretched thin. Dr. Min Lee, a policy advisor called to testify before Congress in May of 2025, captured the stakes in stark terms. She explained that non-bank mortgage servicers, now responsible for more than half of all U.S. home loans, are especially vulnerable to rising delinquencies. Unlike traditional banks, these companies do not have access to Federal Reserve emergency funding. Instead, they rely on short-term warehouse credit lines and operate with capital cushions as slim as 2% of the loans they service. When borrowers fall behind, these servicers are still on the hook to advance payments to investors, local governments, and insurers. If delinquencies spike, the cash demands can overwhelm even large firms. Recent months have already tested the system. Several mid-sized non-bank servicers have scrambled for emergency credit extensions or sold off assets to meet their obligations. Industry regulators warn that a sharp rise in foreclosures could trigger a liquidity shortfall of $10 to $15 billion among non-bank servicers within a matter of months. In such a scenario, the risk is not just to individual homeowners, it's to the entire servicing chain that keeps mortgage payments flowing from households to investors and public agencies. The current wave of equity withdrawals and mounting delinquencies is not yet a systemic crisis. Most homeowners still have substantial equity, and negative equity remains rare, just 2% of loans as of mid-2025. But the pressure is building, especially in regions where affordability is most strained and where non-bank servicers dominate the market. If payment shocks from adjustable rate loans or builder buy-downs begin to roll through, the stress could migrate quickly from the margins to the mainstream. For now, the system holds, but the warning lights are flashing, quietly but persistently, on the dashboard of America's housing finance engine. Karen Sanchez opens her renewal notice and stares at a number she never imagined: $5,900 for a single year of homeowners insurance. She lives in Sarasota, Florida, close enough to the Gulf to feel the threat of every hurricane season, but far enough inland to have always considered herself low risk. Just 2 years ago, her premium was $2,200. Now the bill is nearly triple, and she has not filed a single claim. Her story is becoming common, not just in Florida, but in coastal California, the Gulf Coast, and wildfire-prone corners of Colorado and Mississippi. The word to emphasize here is insurance. Across the country, the average annual premium for a new home insurance policy has soared to $1,966 in 2025, up 9.3% from the year before. In some states, the jump is far more severe. Florida's average is now $5,761, with many homeowners facing bills well above that. The drivers are clear: more severe storms, wildfire losses, and surging costs for reinsurance. Major carriers have pulled out of entire regions, leaving families scrambling for coverage from smaller firms or the state-run insurer of last resort. For Karen, the numbers have forced a reckoning. Her mortgage payment is steady, but the escrow account is bleeding. Last year, her lender warned that the insurance hike would trigger a shortage, raising her monthly payment by $300 just to cover premiums and property taxes. She cut back where she could, skipping vacations and postponing car repairs, but the math no longer works. She and her husband considered selling, but discovered that buyers too are balking at the cost. Several deals in her neighborhood have collapsed at the last minute when buyers learned what it would take to insure the property. The key pressure point is escrow. This is not just a Florida story. In California, premiums have climbed 35% in a single year, and entire zip codes have been declared insurance deserts after major wildfires. In some towns, homeowners are facing non-renewal notices even without ever filing a claim. Across the country, 63% of mortgage lenders report at least one borrower in the past year who could not close because of insurance problems. In high-risk areas, insurance costs can equal half the monthly mortgage. For retirees on fixed incomes or families already stretched by rising prices, the premium shock is the breaking point. Emphasize insurance deserts. The consequences ripple out. Realtors in Cape Cod and the Gulf Coast report a steady trickle of forced sales, families who plan to stay but are now listing their homes, unable to absorb the new costs. Some sellers offer deep discounts or cash credits to cover the first year's insurance just to keep deals alive. Economists tracking home values in high-risk zip codes found that every major premium hike has an immediate effect, with prices falling by thousands of dollars as buyers price in the new reality. In 2023 alone, homes in the hardest-hit regions lost an average of $8,400 in value purely due to rising insurance costs. For now, there is no national database tracking forced sales or delinquencies tied directly to insurance, but the warning signs are everywhere. Escrow shortages are up, payment stress is rising, and in the hardest-hit neighborhoods, the dream of stable homeownership is slipping away. Karen and her husband are weighing their options: sell now before the next hurricane season, or risk another year of premium hikes that could make their home unsellable. Across the country, millions are watching their own renewal notices, wondering how much longer they can hold on. In 2025, the American housing market stands on very different ground than it did before the last crash. The most striking contrast is the sheer amount of equity homeowners now hold. As of the second quarter of 2025, only about 2% of mortgages are underwater, meaning the home is worth less than the remaining loan. In 2009, at the peak of the foreclosure crisis, that figure was closer to 26%. Today, the vast majority of owners have a cushion. Even in markets where prices have softened or insurance costs have soared, most sellers are not facing immediate loss if they need to move. This equity buffer is not just a statistical footnote. It is a brake on the kind of forced sales that once sent prices tumbling. During the last crisis, thin down payments and risky loans meant that even a modest drop in prices could erase a family's entire investment, leaving them with little choice but to walk away. Now, with years of appreciation and stricter lending standards, most homeowners have significant skin in the game. For many, that means they can weather a period of job loss or financial strain without immediately facing foreclosure. But the story is more complicated at the edges. Investors have become a powerful force in the market, accounting for roughly 16% of all home purchases in the second quarter of 2025. In some Sunbelt cities, that share is even higher. These buyers often pay cash, move quickly, and are less emotionally tied to the property. When prices stall or rental yields shrink, investors can shift strategies or exit the market entirely. The result is a layer of volatility that did not exist to the same degree before the last downturn. All cash purchases now make up 29.1% of transactions nationwide, a figure that helps explain why prices have remained sticky even as borrowing has become more expensive. Cash buyers are insulated from mortgage rate swings and can move fast when opportunity arises. In a market where financing hurdles are higher than ever, their presence keeps competition alive for the few homes that do change hands. But it also means that price signals may be slower to adjust, and that traditional buyers relying on loans are at a disadvantage. The mix of participants has changed the rules of engagement. Owner-occupants with deep equity are unlikely to panic sell, and cash-rich investors can absorb short-term losses or pivot to rentals if the math changes. This creates a market that is both more resilient and, in some ways, more opaque. The classic signs of distress, waves of underwater mortgages, and mass foreclosures are largely absent. Instead, risks are shifting to specific segments: investors in overheated markets, buyers exposed to payment resets from builder incentives, and households in regions hit by insurance shocks or economic downturns. What happens next will depend on how these fault lines interact. The equity cushion protects most homeowners from immediate danger, but it also masks brewing stress in pockets of the market. If investor demand fades or local economies weaken, price declines could accelerate in certain neighborhoods, even as the national picture looks stable. The market's fate will be shaped not by a single nationwide collapse, but by a patchwork of local stories, each defined by who owns, how much they owe, and how quickly they can adapt when the ground shifts beneath them. The most likely stress scenario for the housing market in 2025 is not a repeat of the last crash, but a patchwork of local crises, clusters of distress rather than a national collapse. Evidence from the major price indexes points to a market that is bending, not breaking. The Case-Shiller Index showed a 3.4% year-over-year increase in March, and FHFA reported a 2.9% gain in the second quarter, with prices flat from the previous quarter. This moderation signals that while the relentless upward march has slowed, prices remain stubbornly high. The median income family now spends 36% of their earnings to buy a new home, far above the traditional 30% affordability ceiling. Affordability is the pressure point. In many metro areas, especially those that saw the fastest appreciation during the pandemic, the gap between local incomes and home prices has grown too wide to bridge. The cost burden is not spread evenly. Some regions, like parts of the Midwest, still see manageable ratios, but in California, Florida, and the Mountain West, the math has become punishing. Payment shocks from insurance, property taxes, and for new buyers, the expiration of builder buydowns all add to the strain. The market's resilience rests on a foundation of homeowner equity and tight supply, but these strengths are double-edged. The rate lock effect has trapped millions in place, reducing the number of forced sellers and limiting inventory. This keeps prices elevated, but also means that when distress does surface, it tends to be concentrated, visible in rising foreclosures and forced sales in specific neighborhoods rather than a tidal wave sweeping the country. Foreclosure filings rose 17% year over year in the third quarter, but the overall share of underwater mortgages remains just 2%. Most owners have a cushion, but those who bought recently or in overheated markets are more exposed if values soften further. Models from housing economists show that if mortgage rates stay above 6%, the transaction gap will persist, and prices will likely drift sideways or decline modestly in the most stretched metros. If job losses mount or insurance costs spike again, the risk is that these local pockets of distress could widen. Still, the national picture is anchored by the fact that most owners are not forced to sell. The market's thin volume and sticky prices are both symptom and shield, a standoff that prevents a cascade, but also makes recovery slow and uneven. The decisive insight is this: The greatest near-term risk is not a sudden system-wide crash, but a slow bleed, localized pain in regions where affordability has snapped and buyers are scarce. The data from Case-Shiller and FHFA show a plateau at high altitude, not a cliff edge. The cost of housing, now consuming more than 1/3 of the average family's income, will keep demand muted and sales volumes low. In this environment, distress spreads not everywhere at once, but in clusters, visible in foreclosure statistics, price cuts, and forced sales in the hardest-hit zip codes. The national market may look stable from a distance, but up close, the cracks are already spreading. Today, nearly 1 in 3 homebuyers pays all cash, while affordability sinks to historic lows and insurance costs surge. As millions remain locked in place, the real estate market's fractures ripple far beyond housing, fueling generational divides, reshaping communities, and testing the limits of financial resilience. What happens next is not just about prices or policies. It is about whether the American dream of homeownership is still within reach or quietly slipping away.